From Washington, this is the Macrocast with Hamilton Place Strategies and Markets Policy Partners.
Good morning. It's Friday, June 3rd. It's a Jobs Day Friday, one of our favorite shows of the month every month. I'm Tony Fratto with Hamilton Place Strategies. Brendan Walsh and John Fagan from Markets Policy Partners. Matt McDonald with us on Jobs Day, as he is every Jobs Day. Matt, it was like a pretty good report, right? I mean, people were looking for some softening. They didn't get softening.
Yeah, no, really solid report. Headline numbers are 390,000 jobs created in May. Unemployment rate stays at 3.6%. The labor force participation rate ticked up a notch. I believe it's at 62.3, maybe.
Yep.
And then we I guess on the trends, we continue to see kind of pandemic healing in the jobs report, right? So when you look at the underlying numbers, the biggest gains came from leisure and hospitality, which was the sector hardest hit during the pandemic. And then, in terms of hourly earnings, our trailing 12-month increase there is 5.2%, which obviously people are keeping an eye on in the context of inflation and the Fed. That's down from the highs, but I would say still elevated. So all in all, a really solid report. I think on some level we continue to kind of check in on the jobs report every month and see if are we at the end of the pandemic recovery portion of the jobs market? And I think we're still trucking along, which is great for the economy, but also speaks to kind of like continuation of kind of Fed trajectory, I would say.
Yeah, it's going into the jobs report, when people are looking for softening, it's we've had the words of recession in the air a lot more. I mean, obviously the Fed has been on a mission to slow down the pace of growth in the economy, which we're seeing lots of anecdotal and some data signs of certainly. And I think a lot of people, some people were expecting to see that show up in this jobs report. I think a lot of other people were hoping to see that in this jobs report because that would give them a signal that the Fed strategy is working, and a less hot jobs market would be a constraint on inflation. But to your point, I mean, you say pandemic healing, and every time you do, I have Marvin Gaye in my head. I think I should go to a tune. Yeah. But we still are truly in this pandemic. I mean, the transportation, travel, resort, the open economy kinds of parts of the economy are still growing, and they're still having really strong demand. And
even the healthcare sector was able to hire, which is a really good sign.
That's a great point, Brendan. People forget actually that it was incongruous with, healthcare jobs during the pandemic. Actually, in a lot of places, took significant hits for lots of different reasons.
Yeah,
so actually, pandemic healing in the healthcare sector as well.
Yeah, no, it's a good point because elective surgery stopped, so those people lost their jobs. But then it's just like the people in the the emergency rooms are overwhelmed, so a lot of people quit. So it's a good sign that the hospitals are able to start bringing people back and finding people that want to work.
What's the market thinking?
So that's the interesting point when you were saying is good is bad. It's kind of circular reasoning where this report shows the economy is doing fairly well, and also it was a good report in terms of inflation. Wage growth is fine, but we saw an increase in the labor force participation rate, which is a great sign. More people are coming to the workforce, which is not inflation. It's not necessarily deflationary, but it's not inflationary. Mm-hmm. We're still creating 400,000 or 500,000 jobs. though we still are 822,000 jobs below the 152.5 million we had before the pandemic started. Then also, that's a little bit of a misleading point because we should be higher than that. It's been 2.5 years. So, if
maybe,
normal,
well, I don't know.
A million above it. Yeah.
Yeah, but we don't really know births and deaths really well, do we? I mean, so we assume we should be higher, but there are a lot of things going on demographically with.
Yeah. So the point is, there is still room in this economy to add jobs, but the market's very worried about the Fed over tightening. So good data now tends to receive risk assets sell off and treasury rates go up, which is exactly what's happening today.
I mean, it's interesting when you think about the healing of the economy in relation to the jobs market and then the broader economy. I mean, obviously what the Fed is trying to do is like constrain demand a little bit to bring the price dynamics down. I would say that like additional, one of the things that we sometimes, I think in good times, we get a little lazy about the formulation of how the job market functions, which is to say, oh, we created jobs, just kind of assuming that the supply of workers is there and infinite and will fill the job if the jobs are there. That's not how it works. It is a market, and there is the aspect of like you want people wanting the jobs. And one of the dynamics of the pandemic is not only you definitely had jobs go away, you had the health concerns, but you also had, some pretty significant increases in personal balance sheets and a lot of other reasons why people are staying on the sidelines. And I mean, the other dynamic is that I think people getting off the sidelines is also helpful for the inflation dynamics. Like, I'm not sure that jobs increasing is necessarily contrary to some of the goals, because when you have more competition for the jobs that are out there, which has been upside down for a little while, is that will have the tendency to moderate the wage side of the economy.
And digging even deeper into that, Matt, where we were saying we saw a rotation in where the jobs are created. People are leaving, or the goods producing sector is actually reducing jobs, and the service providing sector is creating. We've had a problem. The goods have been incredibly inflationary over the last 2 years because we stayed home and ordered, and we didn't have enough too. The fact that warehouses are laying people off is a very good sign for inflation. Those goods prices are going to come down. And then on the service side, we haven't had enough people at restaurants and hotels, so that's also been inflationary. So the fact that people are coming back to work over there, those both are going to go a long way into bringing these high levels of inflation down in the coming months.
Yeah, I guess on some level, to simplify what we're saying here is that normally we interpret high jobs numbers as kind of like a positive cyclicality with a hot economy and a robust economy that might need to be slowed down. It's not clear to me that that's exactly 100% the way I would interpret a robust jobs report here, because of the dynamic of like, we need more people in these jobs to smooth out the supply chain issues, to help with kind of the wage pressures. That is part of the inflationary healing in my mind, Yeah.
But one of the interesting data points from this report too was there was 295,000 people that were part-time for economic reasons. That means you weren't able to work the full $40. And I think that's very indicative of the warehouses and the goods producing side of our economy.
It seems like, to the point that Matt was making, like labor force participation it seems like it's just everything, right? I mean, if you're looking for the other numbers are great, as long as labor force participation is increasing, I just feel like we should, be calm for another month. If people are being drawn into the labor force, that's great. Right. I mean, it's like more people working in jobs is always a really, really good thing if they want to work. It means that if labor force participation rate is increasing and they're being drawn in, it should be that should have some deflationary pressure. Great thing, right? I mean, it means that you can have growth, you can have job growth without generating inflation. So to me, like that's the biggest number. And you're not going to see big leaps in any month to month. Seeing it go from 62.2 to 62.3, it's like it's pretty good. Keep going.
But when you're talking about 150 million people, a 1/10 increase is a lot of people.
Big, yeah. So markets look like I think they're broadly I don't know. NASDAQ is still
and I think the NASDAQ is more an Apple issue. An analyst at Morgan Stanley downgraded, saying that they're going to miss revenue. So I think the NASDAQ is a micro issue, not a macro issue today.
It is actually worth touching on tech world jobs. I mean, this is all anecdotal. Yeah.
Well, so did you see the Challenger and Gray report yesterday? So they're a staffing firm, and they release on a monthly basis, what sectors are hiring and what sectors are firing. And the fintech industry lost a lot of jobs in the month of May, and by extension, the broader tech sector. But what you saw was the service sector was adding a huge amount.
Yeah, you've had a lot of announcements in the tech space around hiring freezes or potential layoffs, or like I feel like we're in this environment where you get some of the soft layoff stuff where it's like, come back to the office. Oh, you don't want to come back to the office. That's cool. Yeah. We'll see you later. There's like a lot going on in that sector that I tend to think is a little idiosyncratic and probably won't carry over to a ton of other sectors of the economy. I mean, it does point to, I mean, I'm kind of just by virtue of history, I'm a soft landing skeptic, but the tech sector can be, at least from a setting the pace on compensation and the job market and growth and stuff, it can be a bellwether. And if you
we threw a huge amount of money out into the world, and it found a home, especially in the tech sector. We created these things called SPACs, which basically is a way to raise money and not really have to tell anybody what you're going to do with it. And a lot of that fell into startups in the tech sector. And I mean, basically every day you're finding a new SPAC, fell apart and it didn't quite work out. So I think a lot of people started tech companies on, kind of silly ideas, and especially in the crypto space. And a lot of those are getting washed out here.
And listen, part of this, to my mind, is that if you are setting aside maybe the macro or the firm level, but if you're an individual, I would say, if you are thinking about a job change or you are thinking about getting off the sidelines, do it now. Like, this is your time. This is your moment.
But you may not want to
participation rate.
You may not want to send your resume to Elon Musk because
he got to work in the office.
He's always stealing the headlines. So yesterday it was you got to work in the office, and this morning a leaked
don't come to work at all.
Yeah, a leaked memo came out that was basically saying a hiring freeze at Tesla, 10% layoffs of the workforce coming up, and based on Elon Musk's quote, super bad feeling, unquote.
Yeah. Today is on the same page. There's some.
Well, there's a theory that today is McLovin's birthday from the movie Superbad. So he might have been, messing with us on that one.
He wasn't messing on the hiring freeze or the layoffs. So I mean, that was real. And Jamie Dimon wasn't making super bad references.
Yeah, what did you think of Jamie Dimon's comments?
And John Waldron at Goldman, said had some warning talk also. I don't know. Look, Jamie says a lot of things, and
because he was much more optimistic on the investor day, a week or two ago.
Just a week ago, and his research, is not apocalyptic either. Like JP Morgan research. So who knows? I mean, I don't know. I wish we could ask him.
Well, he's our neighbor now. So they moved in next door. And actually, Jamie's going to be the chair of the Bank Policy Institute starting in a couple months. So he'll be in D.C. much more often. So we'll have an opportunity to corner him.
Yeah, and these commentary, this rising chorus of business leaders, economists, analysts forecasting and foretelling, economic clouds on the horizon. There's a storm coming, and Jamie Dimon was saying, and this is obviously, the more the data kind of clashes with that. Obviously, it's hard to see storm clouds in this jobs report, and a lot of the other data that came out, the purchasing managers indexes that came out earlier this week, nothing really all that disturbing in those, encouraging upside surprises and that sort of thing. And there's a sense that the Fed is steering their tightening cycle, with this fair weather forecast, and we heard that repeatedly in Fed commentary this week, that they're looking at the current data. And that data is still charting a course for them of, expeditious tightening. And the labor market is plenty strong enough to handle the kinds of rate hikes that they have in the coming quarters.
Was Jamie's, I didn't read it closely, but when he's talking about storm clouds, I felt like there was a lot of talk around like cleaning up the balance sheet as opposed to maybe the macro picture. Is he just kind of worried about, the tide going out and having the balance sheet a lot of, who's swimming without?
I think it's what he's looking at is so it's all of this. All right, we're in a dynamic environment, rate rising environment with bigger rate hikes than we've had sustained for as long as most people can ever remember. So that plus what's happening globally with oil markets, commodity markets. If you look at things like our friends over at Odd Lots did I don't know if you listened to their podcast on copper prices the other day. It's well worth a listen. It's a great podcast on copper prices. But you have like spikes in certain commodity markets. You have energy that is going to be dynamic and elevated for a long time, and I think that's really what he felt like. This is, we haven't seen a significant consumer response on to prices yet, but it's coming, and he feels it's coming. Now, the thing we know about J.P. Morgan, because we've worked with the J.P. Morgan Institute, and so. And these aren't secrets, they're very public about this. They're able to look at their customer accounts and see economic activity and glean from it. And they're not, so they can make judgments of, consumers are starting to, use more credit, or consumers are, turtling a little bit on, and they may see it, a little bit sooner than it shows up in aggregate government reported data. So you do have to take it with some interest when he says something like that. He may be seeing something that we're not broadly seeing. So, but it just isn't showing up in most of the other data right now, or at least not in a scary way. So I just think he was like Jamie Dimon, colorful language more than making a prediction that a bad storm is coming. I don't think he meant to say that. Yeah, but we'll find out. Hey, let's take a break and come back. I mean, someone who was making some predictions yesterday was Lael Brainard. But let's come back and talk about the Fed and as they're signaling or re-signaling their intentions. You're listening to the Macrocast.
On the first Friday of every month, HPS analyzes the latest jobs and labor market data in a digestible format. Sign up for our reports at hamiltonplacestrategies.com or on Twitter at HPS Insight.
Back on the Macrocast, John Fagan, we had, Lael Brainard yesterday, but we've got other Fed governors and, speaking and telling us, signaling, and I think intentions for the conviction of the Fed in this environment. You started to talk about it a little bit in the last segment. I mean, Lael's making sure that there's no cross signals here, right?
That's right. Yeah, we've seen some mixed messages from Fed officials over the past couple of weeks. The concerted hawkishness that we saw around their previous meeting, the acceleration to 50 basis points, increments from the traditional 25 basis point increments, the beginning of quantitative tightening, which is the roll off of the Fed's balance sheet, which officially kicked off on June 1st. This was all, part and parcel of the very challenging macro environment that we've experienced over the first quarter and into the second quarter of this year, with tightening financial conditions by design, suppressing equity valuations, risk asset valuations, raising treasury yields, both in the front end and the longer end, and putting the dollar up to multi-year highs. Now, this is we've seen a little bit of just a hint of sort of backpedaling among some of the members of the FOMC in recent weeks, discussion about the potential, looking ahead to the potential for a downshift from that 50 basis points to a slower back to a 25 basis points, or even a pause. And that's really been kind of the parlor game of Fed watchers, has been this pause, which was floated by, among others, Atlanta Fed President Bostic, who has been ahead of the curve on this. Basically, his colleagues have caught up to him and his positions over the past year. He's proven to be a pretty prescient operator. And his view is basically that the Fed will be able to, see enough progress on inflation and slowing growth that September might be a time for them to just, put it in neutral, assess the situation, take it easy. Now, when you look at the political calendar, it's always inauspicious for the Fed to be raising rates into an election season. You don't want to ascribe this to politics, but it's always a good time ahead of elections for the Fed to pause. Now, Lael Brainard came out yesterday, and some of the other Fed officials have come out and not directly contradicted this thesis of the September pause, but really emphasized that as Lael Brainard said in her comments yesterday on CNBC, that there is nothing that they see in the data right now that is going to knock them off their current line. And that really is, I think that's the important thing. When we were joking about it, the September pause, the first rule of the September pause is you don't talk about a September pause until you're ready to do it, because the more Fed talking heads chatter about a September pause, the more wind you might put in the sails of risk assets, which makes a September pause less likely. And so it is that sort of self-defeating kind of communications. I think Lael's commentary and from Cleveland Fed President Mester yesterday, echoing her hawkishness, is an attempt to kind of right the ship here and say, hey, look, we're taking this a meeting at a time, and we don't want to be getting ahead of ourselves and start talking about time to take a break. That's
the markets take the message. They price in. What are they pricing in for September?
So right now, the expectation is that September is going to, the pricing really hasn't changed that much. I mean, so we've seen a stabilization in the futures, and that actually makes a big difference. So, the kind of the big market reaction is when the trend begins to, slightly decelerate rather than a full-on turnaround. And so when you get a situation in which Fed rate expectations stabilize, that feeds into a lower treasury volatility matrix, and that thereby helps equity markets find their footing. We've seen that over the past couple of weeks, this counter trend bounce, as Fed expectations stabilize, volatility in markets tend to stabilize as well. And that's that's where we are right now. It's hard for markets to find direction. We've seen sort of rallies fade but declines being bought as well. So this is and we certainly haven't seen a lot of directionality in treasury yields over the past couple of weeks either. So it seems as though there's a tug of war, and the markets are waiting for some kind of resolution, some validation from the data to show them the next direction.
I would say, when you look at the big picture, decades, not kind of the current environment, is that, again, we talked a little bit about demographics in terms of jobs and labor force participation and baby boomers retiring and that sort of stuff. But when you have a aging population, that tends to create a dynamic where there is more money being invested than there is people looking for, oh, I'm going to buy my first house, or I'm going to start up a company or whatever. Like, there's a lot of really interesting research on that. And I would say that, like, the inflationary environment that we're in, people just don't have a mental model for it because it hasn't happened in so long. And all else equal, I do think that we're in an environment where the natural interest rates that the Fed should be setting are probably incrementally lower than they have been in the past, just because of those macro demographic aspects of the economy, of just where most people are and what they're in, usually when you're older, you have money in the market, and when you're younger, you are borrowing to invest in your future. And like, when you have more older people and fewer younger people, like, that has a big driver on kind of where things are. So it's an interesting spot of like where they're going to try and land this and what they're thinking about as like their baseline,
Yeah, definitely. I think, I just think that I think they really are going to be taking it though, month to month, and trying not to project that too far. I mean, they're to your point earlier on, just on jobs, for example, like, I think they know that they are still just emerging from a pandemic, extraordinary pandemic period also. And, they're gonna, I think I don't know, is like inflation targeting dead, or they come back to it, like, are we going to get into a peacetime economy where they go back to talking about inflation targeting, which is in some ways a long-term, readjustment of thinking about monetary policy. Also, we'll see, or it's dead. Who knows? We'll find out. The markets though, I feel like we've had the correction. I feel like the really like
you calling the bottom.
Well, I called the bottom like 2 weeks ago. And I still feel good about, because it's been mostly a sideways market since then. So I still feel like good about my bottom call. But it just feels like major, especially like in the big technology side, the big winners from COVID have all been repriced, in some cases by like massive amounts. Netflix and some others, like, all repriced, and now they're just like they found a level. And John said, looking, sort of, settling to look for direction going forward from here. And I think mostly in a fairly normal way, until they get some signal that says either the Fed's got major moves and it's going to have to step up its pace on either QT or rates, or the consumer is in trouble. And barring those, I just think it's just been one big repricing of assets, coming out of COVID. And, I don't know. I mean,
the caveat on that is that I do not think, I think that's generally true, but if you apply a more expansive definition to assets, is that I don't know what's going to happen with the real estate market over the coming stretch, which obviously from a consumer perspective could be another shoe.
It's interesting though, but it's like, it's different than any other, real estate market. We've had prices can come down, but we don't have an overhang of homes.
Yes.
So we don't have that sort of like classic, oh, what are we going to do with all these empty homes now, and credit destruction. It's like, no, we actually really still don't have any homes. Yeah. So there's no oversupply. There's overpricing, but people are overpriced in homes with really low interest rates.
Yeah.
So everybody's sort of like, stand in the place where you live right now, right?
Even when we look forward, we're less concerned about a near-term recession. We take the kinds of commentary that come from the more optimistic Fed governors and the optimistic side of the debate, talking about household balance sheets doing well, talking about corporate balance sheets doing well. We think that is the kind of dynamic that holds off. Even if we have a cyclical slowdown here in the second half of the year, that doesn't necessarily worsen. And even communications issues aside, we think that there really is a Fed downshift coming, whether it's from 50 basis points to 25 or a pause in September. We think that the stars are going to align for something like that. That should be positive for markets in the second half of the year. But when we look a little bit further out, we have our crystal ball is a little bit darker. The questions about whether oil prices can come down, whether this is really a temporary situation or whether this is a chronic problem. We'll talk a little bit more about oil prices, food prices as well. Yeah. And you have that continued body blow to the consumer. It's not just one quarter, it's two, it's three. It compounds the pressure on consumer. And then you risk, a deeper slowdown in potentially 2023. And then from a market perspective, there was always in the post-global financial crisis era, there was always this sense about the next Fed gusts of liquidity would fill your sails in your portfolio, and you would have a magnificent wind at your back. And that really that's gone. I don't think that there's really anybody thinking that the next upswing in financial markets will be underwritten by Fed. I mean, maybe they're wrong, but people are groping for that different narrative. What is going to drive asset prices if it's not a big Fed trade, the way it's been in pretty much every rally you can name in the post-global financial crisis era?
Hey, John, when my old recollection of the rule of thumb was that it took 18 months for Fed actions to move into the real economy. Is I don't even remember if that's correct or not, but is that still the rule of thumb? And how is the Fed thinking about that currently? I mean, it's obviously a different environment than it's been for a while, but are the markets thinking about it that way too?
Yeah, I think that's exactly right. That's what worries the markets so much about, these good, continually solid data numbers making the Fed go further and further. And so it increases that risk of overshooting, because just as you say, the impact is further down the road. They're going meeting by meeting, data point by data point, but the impact of their policies is not, contemporaneous. And so they're very consciously not model driven, but you got to start modeling at some point.
Definitely. Could we take a minute and take a look at what's to come next week? Actually, not even just next week, but the next big data points we have for to pay attention to. We're going to start getting pricing, prices again, right?
Yes. So the consumer price index comes out next week, which is obviously always very, very important. And we know what the jobs data is. So now it's the other mandate of the Fed, and currently the probably the more important mandate. And then you have a number of central bank meetings across the globe, from the Royal Bank of Australia, and also the ECB has a interest rate meeting. John, what are we thinking on ECB?
They're not supposed to do anything in June. The signals have been kickoff in July, and it looks like the economy is held up well enough so that they are going to be able to do that. There's a cacophony of messaging from ECB officials, but it seems like President Lagarde is still very much in a balanced camp. We're looking, we'd sort of pushed it back, thinking that the EU economy would suffer a lot worse at the hands of this energy supply shock in the near term. But so far, it's held up admirably well, and so that's opening the door for a couple of rate hikes. But we don't think they've got about 100 basis points of rate hikes priced into the futures markets. We think that they maybe get half of that. A couple of 25 basis point hikes, then a pause, and that we think that there's a likelihood that pause extends into the end of the year.
All right, guys. Good jobs day, man.
Was a good jobs day.
Strong jobs numbers and a big fourth quarter comeback for the soon-to-be world champion Boston Celtics.
I have to find whatever glow I can. The glow I have is the Pirates sweeping the Dodgers in LA this week and rewarding me for staying up late for West Coast games. Yeah. So I'm sleep deprived, but I'm gonna get a Pirates tattoo. You know,
The Buckeyes are back.
back, baby.
One of the best stadiums in all of MLB.
Yeah, well, we need to get there together one of these days.
I would love to do that.
Yeah. All right, guys. Have a fantastic weekend. Thanks, Matt McDonald, joining us on Jobs Day, of course. Have a great weekend. We'll see you next week on the Macrocast.
Thank you for listening to the Macrocast. Please remember to subscribe, rate, and share.